Hi, I just want to give my opinion. This is not financial advice. I just want to give my 2 cents on different ways to prepare your child to build wealth for them. The first type of account, there's three different types of accounts we're going to mention. The first one's called the custodial IRA. Really, the requirement for the custodial IRA is your child, your minor, must have earned income. From a job. It could be babysitting. It could be any kind of job, but something that where they earn income. What you would do is that income you can contribute to this custodial IRA. And the nice thing about it is it's tax advantage, meaning the money grows tax free if you put it in a Roth custodial IRA. If you put it in a traditional, they would get a tax break now, but they would have to pay the taxes later. I would say it's probably best to put it in a Roth so the money grows tax free later. I would definitely lean that route for a child because they won't be making that much money earlier on in their life. Now, the thing about this account is since it's a custodial account, the custodian, which is the parent, manages that money until the child, the minor, reaches the age of majority. So depending on what state you're in, it could be either 18 or 21 years old. When the child hits that age, then the child gets control over that account, and the parent can't do anything legally to take back control. So it's very important to teach your child good habits, because if you give them a custodial account, they will have full control once they hit either 18 or 21, depending on the state. Based on this retirement account, pretty much you should not be touching this money before they're 59 and a half years old. If they do take money out before 59 and a half, if it's a traditional, they will get hit with penalties. But if you put it in a Roth, at least the money you contributed won't get penalized. But any amount of money that you take out that is extra earned income would get taxed and penalized. Financial aid impact, it's favorable. So the nice things about these retirement accounts is it's not counted against the student's financial aid when they apply for college. And then also note the beneficiary, you can't change the beneficiary. Once you assign the beneficiary, that's it. The money's going to that person. So that's the custodial. The next type of account is called the UTMA account. There's also one called UGMA. They're fairly similar. Again, with this savings account, investing account, this is a nice way to build wealth. I do this currently for my child. Anyone can contribute, so which is nice. It's not just the child is contributing. It could be the parents, grandparents, anyone. It could be friends. No in-earned income needed. So the child does not need to be working for people to contribute to this account. It is taxable. So just note that it's not a high rate, but it's subject to the minor's rate. So just note there will be taxes on the earnings. Now, in terms of, again, the control of the assets, just like the custodial IRA, this account, once the child reaches age of majority, that asset belongs to that child. This is a flexible account. The funds here can be used for anything, which is nice. It's not just for retirement. Financial aid impact, though, there is a financial aid impact. It's least favorable. So these funds will reduce the financial aid eligibility by 20% of whatever the asset's value is worth. So if you have $1,000 in the UTMA account, for example, um, 20% of that $1,000 or $200, that's how much less financial aid the child will get. And then the beneficiary change again, you can't change who is assigned to. Then, last but definitely not least, this is probably the most popular college savings program. I contributed to this one as well. This is the 529. So the 529, these funds are actually dedicated for education expenses. So that could be for college, it could be for any kind of schooling. Anyone can contribute, just like the UTMA, anyone can contribute to this plan. Um, what's cool about this savings plan is it's tax-free growth. So whatever you contribute into it, um, the nice thing is whatever you contribute into it, once it's time to take the money out, as long as you're using it for education expenses, you won't pay taxes on it. So that's cool. Another cool thing about it, at least in my case, is whatever I do actually contribute, I actually get a small tax break as well. So depending on what state you're in and what 529 plan you select, you can get a tax break on contributing the money. And then if you use that money for college or for any qualified education expenses, your money also will not get taxed on the way out. So that's very powerful. Control of the assets, the account owner, usually the parent, retains control. So that's another nice thing about this account is um, even when the child's an adult, that the parent still has control over the account. Um, Flexibility of use, again, is the least flexible. It's got to be used for education expenses to maintain the tax benefits, or else the earnings get subject to an income tax and a 10% penalty. So definitely, whatever you contribute to 529, make sure you're using it for education. Financial aid impact is favorable. So since it's considered an asset of the parent, the child's financial aid eligibility only gets lowered by 5%. So that 5.64%, that's not bad. It's much less than the UTMA's getting lowered by 20%. And then again, the beneficiary change. What's another cool thing about this is you can switch beneficiaries. So let's say you have multiple children, and let's say the first child you would contribute to 529 gets a ton of scholarships. You can then pivot and say, all right, that child doesn't need the 529 funds. Let me move those over into my other child's name, or to another qualified family member without penalty. So that's nice. So the 529 is most popular. It's a great way to save for like college or education expenses in general. And then you also have the custodial, which is great for retirement, for the child's retirement once they're earning income. I recommend that as well. And then you also have the UTMA account is another option. So these are the three savings options. Enjoy.